Jim, you're in a jacket.
I
Did I
am
set
wearing
him
a
up?
jacket today. Yeah, no, this is like a new suit for me. It's like yeah, this is a big deal. I rarely
Yeah, it
wear a
looks good. Are
jacket.
we having a formal conversation here? Jake's wearing. I feel less than. I feel like I should go into my closet and grab a
Grab a
suit.
tie and a jacket.
Just
Grab
grab
a
a
Yeah,
unit.
tie. Yeah.
Yeah, I was just at the dry cleaner. I should have I should have known this was coming. But I think Jim, I think we're catching you right off of a webinar you just did. I was watching that, so hence the jacket.
yeah. I had the opportunity to speak with Apollo Lopesco from Dimensional Funds, who's always a fantastic guest and
Yeah, he's
does a
great.
great job. Describing what's going on in the markets and articulating the cause and effect with inflation and interest rates and how it all works. So much better than I can do. I'm good at asking him questions, and that he has a great ability to describe things. So it's fantastic.
There we go. Well, I mean, hey, there's something to be said for facilitating great dialogue, which is what we are going to seek to do today in episode 5, Conversations with Baypoint. My name is Zach Frank. I am joined as ever by my stalwart cast of 2, Jim Kintowski, a founder and partner here at Baypoint Wealth, and Jake Sadler, partner at Baypoint Wealth as well. We are not sponsored by LaCroix, so I'm going to put this down.
I've got bubbly, so we're sponsored by fizzy water, but not by look
We're sponsored by carbon dioxide.
equal opportunity carbonators, I guess.
Exactly. But LaCroix, bubbly, if you're interested in sponsorships, I can put you in touch with our head of partnerships.
That'd be awesome. I have liquid death in my cup. Have you ever heard of that bubbly water?
Wait, is that
No.
is that like the aggressively masculine carbonated water? That's the whole thing, right? It's like
It murders
fizzy
your
water for
thirst.
men.
Apparently, it kills your thirst. Is a deal.
It's then an actual thing. This is
I have
yeah.
heard of this.
It's the best water I've ever had. I mean, it's fantastic.
You're
It's
kidding.
sparkling or plain water, and it's like directly out of some mountain out west, and it's fantastic. But the name and it's the can design is not one you would think would be highly marketable, but I buy it.
No, there we go. Some counter programming to the French and pastel coloring of your
Yeah,
standard
My
standard
black
fizzy
and
water.
gold.
Okay, yeah, liquid death. All right.
I'm keeping on theme with today's topic since bubbly's owned by Pepsi, and Pepsi's a pretty reliable dividend payer. So
Oh, there we go.
I like how Jake goes to the topic. He wants to get to it.
We love to hear it. We love to hear it. But Jake, I'm glad that you brought us to the thrust of our conversation, which is dividends, dividend paying stocks, everything you always wanted to know about dividends, but were afraid to ask. And we are talking about this because Jim recently wrote an article for the Baypoint blog about living off of your dividends and how you might be able to do that. And dividends, I think, are a subject that many people know a little bit about. Some people know a lot about, but about which there are, a few misconceptions. And I'm going to tee us up, Jim, with a pretty straightforward question. What is a dividend? What is a dividend paying stock?
Yeah, so a dividend is essentially a profit that's paid out by a company, and it's paid out either on a quarterly basis or primarily a quarterly basis. And so, a company earns money and they have extra money and they want to return it to their shareholders. They pay out a dividend. Simple.
Gotcha. So it's what you get for being a shareholder for the dividend paying companies. Because you helped us grow, we are going to give you some of our profit.
Yeah, exactly. You're an owner, you're participating in the profits of the company, and this is one way to earn money on that ownership, is being paid a dividend. Yes.
Great.
Dividends are not guaranteed in any way, and they're not required to be paid. They are announced, and they can be terminated if necessary. So for a company to
and we're going to definitely. Yeah, we're definitely gonna get to that point that they are not guaranteed. Because I think that's one of the sort of essential things to know about them, especially when you consider them in comparison to, maybe they're like, kissing cousin, fixed income products and fixed income securities. But I wanted to ask because, I know, for clients who are in retirement or nearing retirement, dividend paying stocks can factor quite a bit into their plan. And just, how do dividends, why are dividends such an important piece of the constellation of retirement assets?
Yeah, so I mean, one of the reasons we wrote this article is not necessarily because we are recommending this strategy, living off dividends. It's more, we get asked this question a lot. This is probably one of the most frequently asked questions that I get. Hey, why don't I just buy a portfolio of dividend paying stocks? I earn some money off those stocks in terms of dividends. I don't care if they go up or down, and I'm going to live happily ever after, off those dividends. And so really, it's sort of the pros and cons of trying to do that is having a dividend paying portfolio and just living off it in retirement.
Gotcha. And I guess, sort of the next question to that would be, so why don't you? If I were retiring, I came to you and I said, why don't I just purchase a, basket of dividend paying stocks, individual stocks that each pay a dividend, make sure it's diversified, 20, 30 of them. So, my fortunes aren't tied up in, Pepsi or, Coca-Cola or Johnson & Johnson. But why not? Seems logical, right?
Yeah, it does seem very logical. And I guess you say diversification, and what does that mean? So you just said, hey, 20 to 30 stocks. Is that diversification? Do you feel comfortable taking your whole retirement portfolio, number one, and putting it in 20 to 30 stocks? And we'll get into the reasons why, but there's a lot of risk associated with that. We're using the word stock, and you are not buying a safe investment. You're buying something that pays a dividend, but that underlying investment is very risky in itself, and it can go up and down significantly with the market. So that's one thing. To me, it's like taking all your eggs and putting it in one basket. The other piece is, so you can get safer investments through fixed income or bonds, and then you can also get the potential for more growth out of different types of stocks. So when we look at generating income for retirement, it's not just from dividends. It's from interest on a bond. It's from growth of those stocks that you're investing in. So it's a combination of different factors. And so I would say primarily for me, the biggest reason not to just say, hey, let me build a dividend paying portfolio is because it's putting your eggs in one basket, and it's more risky than one would think. And you can enhance your performance by investing in other types of investments, other asset classes, other types of stocks, or potentially fixed income. So it's getting some additional diversification and minimizing that volatile ride that you may have in retirement.
Yeah, I mean, Jim, I'm with you. Just to, I got a lot to say about dividends. I think just hearing you talk, and it is one of the really common questions we get as folks really begin to think through the mechanics of, okay, as they're preparing for retirement, they're getting close, they've saved and they're ready to take the plunge. How do I pay myself from my investments? And Zach, to your point, dividends they're just a really logical kind of sound mechanism. I think on the surface, the investments that I'll own, I want to own these stocks that pay me a portion of their earnings. And I'm just going to rely on that for my income. But as Jim pointed out, in an effort to concentrate your portfolio and build a portfolio around these dividend payers so that you can get the income that you need, you really sacrifice diversification. So not all companies pay dividends. I think that's really important to note. And the companies that do pay dividends, they can stop paying dividends at any time, or they may have reasons that they want to pay dividends to convince their investors that they're a great company to invest in, they're in solid, financial shape, they're paying out these dividends. But the reality is the underlying company itself is maybe struggling. So there's a lot of risk in concentrating a portfolio in this direction of dividend paying stocks. And at the end of the day, it doesn't really solve most people's income dilemma or income question. And so as Jim was pointing out, we take a total return approach when it comes to an investment portfolio that needs to deliver income. So we want dividends. They're great. They're important. They contribute to our return over time. We want interest from bonds. The bonds don't carry as much risk as the stocks that pay dividends. They're all paying us income. And we also want those companies that you will really rely on capital appreciation over time. So maybe they're not paying out dividends, but they're growing over time. So, we really want to focus on identifying a mix of stocks and bonds, maintaining that mix through regular rebalancing, and let that be the main mechanism that delivers income, for most of our clients, not just relying on one of those individual components.
Our session is done. I mean, Jake just nailed it with that explanation. But the one thing I did want to,
it's awesome.
I did want to point out.
Go back to talking about fizzy water.
Yeah, we can talk about fizzy water. The one thing I did want to point out to Jake's point, I love the comment you just made, Jake, is the biggest question that we get is, how do I pay myself? There's really three main questions that I see in terms of when meeting people. It's, will I have enough? The second question is, where will my money come from? And then the last one is, where will my money go? But that second question, it's really, really hard for people to wrap their head around. It's like, I got all this money. How am I going to access that money? And so the logical explanation, which Zach mentioned earlier, is that, hey, these things out there pay income and they will provide that source of income. But as you've just described, Jake, there's probably a much better way with less, or giving you the ability to mitigate your risk to do that.
I think, kind of one of these really common, comments that we hear, and I think it's natural and logical to want to kind of think this way, is I want to preserve my principal and live off my earnings. And when you tie that thought, which makes sense, right? I don't want to, spend down what I have. I just want to take the earnings. When you look at that within the context of just kind of a concentrated dividend paying stock portfolio, you really run a lot of risk, because, it's like a game of musical chairs when it comes to the actual paying of the dividends, and the music will stop at some point in time. And when that music stops and a lot of your dividend payers stop paying dividends, it's probably going to be at a point in time where asset values or prices are down lower. So you could be put in a position, if that were your kind of mechanism for income, where you actually have to sell some of your investments at the worst possible time, when they're down in value, not paying their dividends.
Yeah.
Yeah. And I'm glad you brought that up, Jake.
No, go.
Right. I'm doing it. I'm taking the moment. But no, Jake, what I was saying is, I'm glad you brought that up, that, what do you do, when prices are down and, companies are either reducing their expected dividend or cutting the dividend off entirely, because, again, it's not guaranteed. It's not backed by an asset. There's, you have no claim to the dividend absent them declaring it. That might happen when prices are down. It might happen at a time like we're seeing now, when, everything else, the price of everything else is up. I mean, as of the day we're recording this, the most recent inflation print is 9.1% year over year. And if you're living exclusively off of the dividends at a time when security prices are down, dividends may be stopped, and the prices of goods and services themselves have risen quite high, it seems like you might be in a bit of a precarious position.
Yeah, I think that's a really good point, Zach. That there's a lot of kind of competing forces out there for our what we're paying attention to. We could be concerned with inflation, with security prices, or the dividend yield on our investments, and they don't always kind of line up one for one. Like right now, okay, we're security prices are down, stocks are down pretty sharply here this year. Inflation is way up, 9.1% is the most recent number. But yesterday, actually, there was an article in the Wall Street Journal. The June dividends are out, and the S&P 500 paid out a record dollar amount in dividends, so over 140 billion in dividends from the S&P 500. Um, Interestingly, so I mean, like that noise is out there, that information's out there, and could lead some to say, okay, wow, dividends are really more dividends than ever. But in fact, the dividend yield of the S&P 500 is below its historical average right now, still below 2%, and it could go down further. So if companies' earnings take a big hit, if we enter into a recession, there's going to be a bit of a lag period and wait till we get that information. But again, if you're relying on dividends, sound pretty good right now. But I think when you kind of take a step back and look at it within the broader context, I think there's still a lot of risk in concentrating exclusively into dividend-paying stocks to meet your income needs.
Yeah, I had a situation, and I'm sure Jake, you've run into this situation, but back during the crisis of 2007, 2008, people relying on some of the bigger name companies. Like one example I had, correct me if I have this wrong, but Bank of America, was at a very, very high number share price value, and they paid a consistent dividend for a really, really long time. And not only did the share price go down significantly, I believe the dividend was stopped for a period of time. And so, just that was historically, that had been such a good ownership position for a long time. People get comfortable thinking, hey, this is never going to change. And as we've seen in the markets recently, and we see in those difficult times, things do change. It's just a matter of time. We go through these really long periods of positive returns, long periods of negative returns, a lot of volatility, and it's a constantly changing environment.
Yeah, it's interesting. I don't think that Bank of America scenario was entirely unique. I have seen the exact same situation, during 2008 with Bank of America, where, if you're holding a concentrated position there, whether you built that up yourself over time or if it was inherited as a legacy position for a long time running, those dividends came in, nice, consistently, and, could really, for investors that own that, they could really rely on that for their income needs. And then the music stopped. And investors were left in a position where if they didn't have any other assets to draw from or any other income sources, they would have been forced to sell their Bank of America stock at the worst possible time.
Yeah, you got it.
Yeah, I know I think the numbers that we're talking about specifically, it's like an eye-watering fall. It was something like all-time high of 51 dropped to $3, I think $3 per share during the lows of the crisis. And I don't think Bank of America has ever regained those highs. I think it came close last year, but did not quite.
It's I think, Zach, to kind of back to your original point, dividends are great. It's a nice income source. Dividend paying stocks are not an apples to apples to, say, bonds in the portfolio, when it comes to delivering consistent income and that promise to deliver consistent income.
Yeah, and I want to touch on that point, that promise to deliver income, right? Because, you can get used to a dividend paying stock and get used to that, quarterly, annual payout, depending on the scheme. But it's not guaranteed. And so I just want to sort of focus a little bit on what that distinction is. Why are they not guaranteed versus, say, a bond? And how might you explain that to a client when they're asking about sources of income, specifically income in retirement?
Jim, I'm happy to kind of dive into that one because I was just having this conversation very recently, and a bond at its core is a promise. And you're loaning your money out to a company or government entity, and it's a promissory note. So you're lending your money out, and they're borrowing it, and they're promising to pay you back what you loaned them plus interest. And this is very different, when compared to owning a share of a company. You're an owner of the company. And you've got to take the good with the bad, and you're hoping, you have this expectation that the company is going to have, positive cash flow and revenue and profits over time, and that they're going to deliver a portion of that to you as a shareholder. But it's by no means a promise that will occur.
Yeah, and I don't. We got to be careful. None of it's guaranteed, whether it's a stock or a bond. You could, if a company goes bad, the first people in line to lose their money are the stockholders. And then it's not likely that you'll get your whole principal back if a company does go into bankruptcy. I mean, you are in better shape than a stockholder, but you could still lose a significant value of your investment. And Jake phrased it right. I think it's a promise there. And
Promise and guarantee are dangerously close, but they're definitely not the same.
Yeah.
Yeah, certainly. And just hearing you talk about the way clients have come to you and talked about income in retirement and thinking about dividends as a either relatively safe or at least safer investment style for their retirement years. It strikes you that there's like it seems like a pretty strong and compelling psychological argument to be made there, right? Because if you spend however many decades working, drawing an income, drawing a regular stream of payments for what you do for money, and then that stops, then you're in retirement. Dividend paying stocks seem far more analogous to the scheme in which you work for money or receive partnership or ownership distributions from the firm that you might have an ownership stake in, than say selling the capital growth on your basket of stocks. That seems just like a different animal.
I mean, that's a really interesting point. Like this difference between these dividend, generating companies versus those companies that aren't paying a dividend, but who have terrific capital appreciation over time. Why, if you want to, build a diversified portfolio, would you want to exclude such a meaningful portion of the market of those companies that tend to be growth companies that they don't want to necessarily pay out their revenue? They feel like they can do better with their money and put it back into the company. You'd be excluding, a lot of big names. I mean, you look at the S&P 500 today, there's about 80 companies that aren't paying dividends right now. Among those, there's some pretty big household names that aren't paying dividends. Amazon, Google, Facebook, Berkshire Hathaway. These are companies that, as an investor, you're likely going to want to own in a diversified portfolio to participate in their capital appreciation over time. But again, if you're, taking just dividend payers and excluding the rest, or excluding proportionally, saying I want less of these, you're potentially leaving a lot of return on the table for the portfolio. Again, that's kind of why we go back to that total return approach.
Yeah, diversification is a really key factor in making all this work. And I get it. Like, I understand that it seems really hard to figure out where your money is going to come from. I mean, that is a challenging question when you retire, because as you said it, Jake, Zach, you're receiving a paycheck. You got money like coming into your bank account, and it's on a regular basis. And so you stop receiving that, and you want to replace that. So it's like, how do I replace that income source? And one of the obvious ways to do that is through these dividend payers. And I would say also that it became probably more popular. We went through a really, really long period with a very, very low interest rate environment. And so people were saying, hey, these fixed income products, these CDs, I can't generate any type of interest off them or anything. So what can I invest in to get more income? And so people lead towards these different types of investments. But with that, if you're going to look for more income and you're looking for a better return, there's a really, really good chance that risk is coming along with that. And so, that's all investments are, is a risk return scenario for the most part. So you got to be careful when you're looking for more return. There's generally some risk associated with it.
Yeah, and hearing you talk about the fallow period for fixed income securities when interest rates were basically at rock bottom. I do wonder, as we sort of enter into this brave new world of higher interest rates, and as bond holdings and fixed income holdings turn over and start producing higher yield. If there'll be sort of less of a emphasis, in the mind of the retiree or the soon to be retiree or any client on dividend producing.
Yeah, that's a really interesting point. I think maybe we're kind of move away a little bit in just in terms of kind of these common questions we get. Maybe now instead of just focusing on dividend, paying stock, it's is my income coming from dividend paying stocks and bond interest? Because now that's more maybe top of mind. It's kind of more out there, in the news media. But at the end of the day, we're not doing anything different. Dividend income is extremely important for all of our portfolios. Interest income is extremely important for all of our portfolios. Nothing changes, right? So capital appreciation is extremely important for all our portfolios. We're still total return investors at the end of the day. So, but maybe like you said, Zach, maybe it's going to become a little bit, easier to kind of get from point A, which is like, oh, dividends are going to pay my income from my portfolio in retirement, to, okay, now it's dividends, and interest from bonds. And then it's not too far to go in that thought experiment to say, okay, and capital appreciation, I'm a total return investor.
Yeah, it's like illustrating. It's like, how do you illustrate that? I mean, these things are complicated to look at. And so, so it's hard to illustrate like the total return piece of it.
And it's very difficult to kind of conceptualize. We want to like look at things in 2 dimensions, but this is 4 dimensions. We've got a lot of moving pieces in the portfolio, lots of different sources of income, and it's transpiring through time. So it's really difficult. We, may need to adapt and make changes, but it is very difficult to conceptualize. At the end of the day, because we don't know what companies are going to pay what dividends, and we don't know what interest rates are going to do, and we don't know what capital appreciation is going to look like, we want to build a portfolio based on a set of rules. And that set of rules will allow us to navigate this uncertainty around where income in the portfolio is actually being generated, whether we're placing trades, selling what's up in value, to make sure you have the cash you need, or drawing from dividends or interest. Having that set of rules in place is, at the end of the day, what's most important.
Yeah, Jake, I just wanted to, briefly in the time that we have left, I just wanted to ask you, because you mentioned it a few times, just could you explain for our viewers and listeners just what is total return investing? When we think about, total return, because that's one of those sort of like classic phrases from modern portfolio theory that may not be, that definition might not be near at hand for just anyone who might.
No, that's a really good question. So, the total return approach allows an investor to take the money they need for their spending without solely relying on dividend or interest yield. So the portfolio yield. And I think that's, at the end of the day, what it boils down to is that your spending needs aren't solely met by the yield from the portfolio. And if it were, you would have to monitor.
Sure.
Yeah, go ahead, Jim.
Yeah, I would just elaborate that on, because it's like trying to find an easy way to explain it. And so, and I guess one of the ways we do it is, if you looked at, like, let's say you needed like $5,000 or $10,000 worth of income in a month, you got to look at all your sources. So those dividends, if you put that, if they came into an account and it was $2,000, you got to say, all right, where am I going to get that other $3,000? And so you have to dig into the balance of your portfolio here, and hopefully you would sell something, and hopefully that's from something that grew in value. And so you're sort of taking some of that growth off the top, and you're combining it with an income source to get that $5,000 or $10,000 that you need. So it's like all this stuff comes into one pot, and then it goes out to an account. And simplifying it it's a hard thing to do, and it's challenging. So not the way we look at it is, so we sort of do that on the back end. We create a pot of cash from the growth of stock, dividends, and interest, and then we just have that money go into a checking account. Like, people are still getting paid. That's the way I like to think about it, is let's set this thing up so you're still getting paid, and let's make sure that amount will last for your lifetime, and your portfolio will be able to support that.
Yeah, I mean,
Yeah, yeah.
I was just going to piggyback a little bit on what Jim, what you were saying there. I mean, at the end of the starting point for building a total return portfolio to meet your income needs really starts with identifying what your needs are, what are your spending needs, what are what's the size of your portfolio, how are those two lined up, and then identifying an appropriate overall mix of stocks and bonds. And that overall mix of stocks and bonds then creates kind of this baseline from which you can draw the dividend income and the interest income that you need. And then, just like in Jim's example, for the rest of what you need to rebalance in the portfolio between the different categories of investments. So, for example, between stocks and bonds.
And some people do.
Yeah, it sort of sounds like the goal is to invest in such a way that allows you to be agnostic as to the asset class you're drawing from, because once you draw from it, you're rebalancing according to a rules-based investment practice, and you'll get back to where you need to be able to.
That's really important. Being able to set the stage for yourself to do it over and over again, and that's where consistency is really essential. When you're thinking about paying yourself in retirement. And that's really one area where dividend paying stocks can potentially fall dangerously short in a strategy if you're relying solely on that.
Yeah. And Jake, I'm going to add to your point about all this ties back into what you're spending. And, so, as much as we're sort of beating up on this idea of living off of dividends, if you're not spending a whole lot of money and you don't need a whole lot of money and you have other income sources and you just need to supplement your income with some dividends and, you're not too worried about losing it or going away, like it might be a perfectly valid way to go for you if you're comfortable with that. And so you might have a pension, you might have Social Security, and you just need a little extra cash. And so dividends might provide that solution. So looking back at what you're spending, looking back at what your needs really should drive all these decisions that we're talking about.
Yeah, no, that's a really good point. If just say you need 1% per year as a withdrawal rate from your portfolio. And let's just say on a diversified, stock portfolio on the stock side, it's got a yield of about 2% on dividends. And your allocation is split 50% stocks, 50% bonds. Well, that 2% that's coming from half your portfolio is getting you the 1% of the overall portfolio that you need for your annual withdrawals. So in plenty of circumstances, yeah, you can end up living off your dividends. We just kind of don't want to fall into a position, I think, as investors where that's the only tool in our tool belt.
You got it.
And just one final question I wanted to ask either of you, opening this one up to the floor, as it were, because the way we've been talking about this, it sounds like we're talking about dividend stocks, and to my mind that sounds like individual stocks, like Coca-Cola. Coca-Cola is an individual company that's an individual stock, and it pays an individual dividend on that stock. And while many clients, many investors do hold individual stocks, the trend for many years, and certainly the one that we recommend, is not to be in the individual stock picking game, but to instead be holding a fund, whether it's an index fund or otherwise, an ETF mutual fund, that itself owns many individual stocks. So the onus is not on you to basically generate your own alpha when it comes to finding the exact right company. But do the way dividends work, and does that change at all if we're talking about a fund that produces dividends as opposed to the share of a single company that produces them?
So I would just say that I think both ways are doable. So you're talking about building your own stock portfolio, paying dividends, I think, is the question, versus investing in some sort of investment product that is a basket of dividend paying stocks. So you're not out there buying them yourself. I think that's the question you're asking. And, and I think if you really truly are doing like a dividend paying portfolio, I think people limit themselves to the 20 or 30 stocks that you're talking about, maybe more, but it's not as, I want to say, as challenging to do if you're only investing in dividend stocks as if you're investing across the world. So it might be a little bit more manageable to do as an individual investor. Now, having said that, I mean, it takes a lot of work. It takes a lot of management, and you can certainly get a very simple solution through a investment product that is geared towards dividends, and that's a way to do it. You just pay a little bit extra cost for somebody to do that for you. And I think, like you said, and Jake's articulated, like the investments we use, they own dividend paying stocks within there, and it's just part of the overall investment mix. So I don't know, Jake, you got anything to add to that? How is that in terms of?
Well, I mean, again, I think it kind of comes back to as an investor, what your investment approach is going to be. I mean, mutual funds, just for example, they are required to pay out the dividends that are accumulated, and you got to do it at least annually. They don't have to necessarily do it quarterly, even though dividends are coming in quarterly. So, I mean, if the kind of question is, if I own mutual funds and I own the broad market, just say the S&P 500, am I going to get dividend income? And if you own a mutual fund, like S&P 500 mutual fund, the answer is yes. You're going to get dividend income from that fund. If the question is, if I own a mutual fund like S&P 500 index fund, am I going to in any way kind of be, gearing myself more towards dividends? The answer is no. But if you wanted to build a portfolio using mutual funds that was concentrating more towards dividend paying stocks, you would have to then go out and select mutual funds where that's the objective. So, and in the process of doing that, again, you're going to be excluding broad and important swaths of the total market that you may or may not want to actually exclude.
All right. Well, I am checking out our record clock here, and I am sorry to say that we are up for time for today. But I would encourage everyone listening to go to Bay Point Wealth's website to read the article that was the basis of this conversation on dividend-paying stocks and how to utilize them in your retirement portfolio. I was joined, of course, by Jim Kotowski and Jake Sadler, and we will see you next time.